What's up, guys? Welcome back to the channel. So, if you are not aware, you may have heard that SVB Bank has liquidated as of last week. But did you know that there was a second bank that also liquidated? That's right. You guys may not have heard of it, but the crypto focused bank Silvergate is also shutting down operations. Now, for you all who aren't familiar with Silvergate, they are a cryptocurrency bank and they are the second largest cryptocurrency bank in operations. They're actually behind one of the larger cryptocurrency banks that has over $100 billion. Well, Silvergate has roughly $11 billion. So they are not a massive, massive bank, but they are the second in the game in terms of cryptocurrency, and they are no more. Now, discussing the second bank that is shut down that has made the news and plagued everyone's news feed, Silver Valley Bank. They are the largest startup tech bank in the country. They actually have funded over 50% of all of the startup and venture capitalist funds in America, and they are no more. They've shut down. They are 300, we were a 350 billion something dollar bank, billion with the B, folks, and they're no more. They're shut down. And one of the reasons that they shut down is because they were over leveraged. Now, for those of you who are not aware, the Federal Reserve requires that banks, all banks, have what's called a fractional reserve policy to where you have to maintain 10% of your reserves. Here's a little known fact I want to brush you guys up on if you're not aware. It's very weird, but it's something the banks can do. If you go and deposit $10 into a bank, $10. The bank is allowed to lend $90. Bank has $0. You're the first customer of the bank ever. You walk in, you give them $10. You think that the bank can lend out $10. No, the bank is allowed to write up in the computer system $90 and lend it out. And so long as it's a 9 to 10 ratio, 9 to 1 ratio, meaning they have 10% reserves, they meet the requirement. You would think, how do you go bankrupt when you only have to meet 10% reserve requirement and you can lend out 9 times the amount of money that you actually really have? It's ridiculous. That's how banks work. And yet and still SV Bank collapsed. So how did this happen? Well, the Federal Reserve removed the 10% requirement, which is a very low requirement, if you ask me, as a result of the pandemic years back. And they were yet to implement that requirement into the banks. And so all of the banks, large banks, small banks, medium banks, all of them were still lending with zero cash reserves on their books. Now, if they were a very well managed group and very well managed bank with good CEOs, good management, well, they were going to not over leverage so that they can have some fiscal responsibility. Well, apparently SV Bank didn't get the memo. Their executives over leveraged, their accounting firms, their risk management teams over leveraged. They said, what the hell? We're still going to continue to eat. Uh-uh. The Federal Reserve walked in, they raised the rates, which then put SV Bank and a lot of other banks into a tightening mechanism to where they didn't actually have the capital anymore because the cost of money went up. And so SV Bank went down there. Now, what's so concerning about this is how quickly it happened. There was no mention of any issues with this bank or any other banks as of last week. And then in a matter of 24 hours, as of Thursday or Wednesday, all of a sudden, bank collapses, shuts down, FDIC walks in, they take over, and then boom, that's it. Very quick, very fast. And people are currently concerned that it is not going to be reduced and limited to just SV Bank and also to Silvergate. People are concerned that this is going to go into other banks because you have to remember that banks are all connected. They are like a very symbiotic, closely connected, small network of money lending systems. And so generally, a lot of the banks follow each other's guides. If a large bank is overly leveraged in a particular asset, and this isn't always the case, but generally, when some banks are over leveraged, some many, many more are to follow. And the reason this is a concern is because you have to consider the companies that are currently invested into these banks, such as Etsy. So Etsy, Roku, and a lot of other companies are currently having issues with receiving and withdrawing their money. Now, this is probably past the point of being able to withdraw your money because the FDIC has already stepped in. They set up a separate account, a separate agency specifically for insurance deposits, refunds. So, SV Bank, as we know it, no longer exists. There's a separate agency That's now been set up by the FDIC. So that if you had $250,000 into your account, you're okay. But here's the problem with this. The problem with this is that SV Bank had less than 2% of its customers were actually meeting the $250,000 below threshold, which means that 98% of its money did not meet the FDIC requirement. It is put money gone, not getting it back. See you later. I'm talking about billions. So if a company has a $340 billion market cap, imagine that 98% of that is wiped out completely. The Federal Reserve says, we are not giving it to you. Thanks for playing. See you later. Now, one of the things that could happen that people are also very concerned about is that the Federal Reserve and the government may step in and do what's called a bailout, to where they then give the bank money. They draw up money, they print it up, and they give the bank money so that the bank can continue to run. That is a possibility, although I think that we continue to set another precedence. If you guys remember in 2008, this is identical, very, very eerily similar to what we had. What's also very concerning right now is that Jim Cramer came out a few days ago and said that J.P. Morgan is a vault, that they are a fortress. Now, here's why this is so concerning, because Jim Cramer, God bless him, doesn't have the best track record, at least not publicly. So it seems as though that everything that he seems to verbally recommend goes down, and everything that he doesn't recommend, it says that's horrible, immediately seems to go up. So it's almost kind of like it's almost like the kiss of death, the anti Jim Cramer theory. And so just last month, Jim Cramer had came out and said that SVB was a buy, that it's going to be rebounding, and that it was looking very tempting for a rebound. And then you see what happens. He made the same call in 2008 with Lehman Brothers. Don't sell Lehman Brothers. Lehman Brothers is good to go. And I think within a matter of 2 weeks, Lehman Brothers was collapsing. The reason this is so concerning is because when you have professionals that are online giving recommendations to retail that we think are the experts, and they're consistently getting it wrong, but that leads us to believe that they're doing this intentionally, that it's not accidental. And so when Jim Cramer comes out a few days ago and says that JP Morgan Chase is a fortress, to me, that is a red flag. And the reason it is because JP Morgan is the largest bank in the country, even more so than Bank of America. And so we may have a situation on our hands right now to where if something comes out to where JP Morgan turns out that they are becoming insolvent, or that they can't meet their debt, or if the Federal Reserve continues to raise interest rates and we find out that JP Morgan is over leveraged in startup companies or in cryptocurrency or even in the real estate market, right? That's how a lot of these companies got caught up in 2008. They were over leveraged in the real estate market. And then, of course, we had AIG with the insurance-backed mortgages and the MBSs. If we find out that JP Morgan is over leveraged and they're having a problem, we are talking about a systematic collapse. We're talking about bailout. We're talking about Federal Reserve is stepping in. It will be absolutely massive. It will be 2008 all over again. And it might even actually be worse. And the reason being is because we now currently have issues with not only with the banking industry, and not only with inflation, and we have record inflation rates, but we also have the inverted yield curve of the 2 to 10 year. We also have the 2 year bonds that are below a certain price point that are giving an indication of a massive recession. And we haven't had a recession in 14 years. Now, while no one wants to hear this, recessions are necessary to flush out the excess liquidity into the economy. If you don't have recessions, when there's all this money that's been printed through the pandemic, what happens is that the money becomes very low valued. It becomes basically not even worth the amount of paper that it's printed on if it continues to print. Basically, a gallon of milk will become $10. A house will be $1 million for a one bedroom somewhere in San Francisco. Like the actual amount that you can purchase with that money will basically be very, very devalued. If you guys remember back with Germany, back during the war, they had an issue with record inflation, and it was so bad to where you literally saw people lighting their homes to keep their homes warm, literally setting the money on fire. If you look at SV Bank right now, more than 85% of deposits were not insured. So I think I said it was close to 98. Excuse me, they're saying 85. I saw somewhere else that it said that it was 98. A lot of money, lot of money, a lot of bad bets. Another thing that we have here is how the heck does two banks collapse in 48 hours? Well, this happens because of leverage. You have banks that are highly leveraged, they have no cash capital reserves, they heavy involvement in tech startups. Right now during recessions, tech startups are not the way to go. If you guys remember back in 2020 during the pandemic, everything was the craze for the startup companies. You had these SPACs. There were these small companies that were getting these venture capitalist funding, and they were just everyone was a SPAC. You get a SPAC, you're a SPAC, and you saw what happened. A lot of them went under, and right now, if you're over leveraged in very speculative companies such as SVB, you're going to have a problem. We don't know we don't know how far this can be a contagion. We just don't know. And so if you look on Fortune magazine, they are talking about how it could lead to a contagion, that a lot of other regional banks may be exposed to this. We don't know. They're saying that they don't think it's going to be systemic risk. I think that it will be. And the reason I think that it will be is because all the banks are connected. And so we find out that, and trust me, I do think that we're going to find out in the next week, 2 weeks, 3 weeks, a month here, just like in 2008. Well, so I want to walk you guys through the timeline that usually when banks start to fail, it is a domino effect. You have one bank, then the next bank. Michael Berry came out on Twitter a few days ago and he said, now I'm just waiting for the next WorldCom. If you guys don't remember, Michael Berry was the one that called the financial crisis back in 2008. He made a ton of money. That's why they made the movie Big Short about him, and he just made a ton of money. I want to go through with you guys the timeline 2008 and talk about the financial crisis because this is very important to kind of go over what I think we may be experiencing now in 2023. If you look back in 2008, we had issues to where the home sale rates fell to the lowest in 10 years. What do we have right now? We have lowering home rates. You have the FOMC, they lowered the Fed funds rate. We don't yet have that. We actually have the Fed funds rate that are raising. So that's not something to look out for as of right now. We also have a situation to where we haven't had a Federal Reserve emergency meeting yet, but I think this could be coming if we find out over the next few weeks that a lot of these banks are exposed. You look out for that. We're going to see that coming. Another thing that we also found out, if we take a look, is we then start to see another influx of banks failing. IndyMac failed. Paulson came out and spoke. Then we have the big bank that failed with Lehman Brothers. That's where the global pandemic. This is what I'm concerned. Uh, this is what I'm really concerned about right now. That J.P. Morgan may be the Lehman Brothers version of this if Jim Cramer kiss of death is correct, which just seems to be 95% of the time. We're not even going to talk about the fact that I saw a article on Twitter. Somebody did a screenshot to show that JP Morgan had the largest amount of dark pool trades behind the scenes last week. So there's a lot of movement with JP Morgan stock right now. We don't know why or what's going on, but it coincided the very day that Jim Cramer came out and made that statement that he thinks that JP Morgan is a fortress. So we're going to find out really quickly in the next few weeks or a month or so. So I think that this may be the Lehman Brothers. This is what we had back in September 15th. They collapsed. And then at that point, all hell broke loose. That's when the Fed went out and they bought AIG. If you guys remember AIG, they were the ones that did a lot of the insurance back for a lot of these mortgages and a lot of the mortgage-backed securities and the collateralized debt obligations that were taking place in 2008. The long story with this, if you guys don't remember, in 2008, what took the financial industry down wasn't even the over leveraging. What took the financial industry down in 2008 was the over leveraging with the insurance. So you basically had investors. Well, let's take us back another step further. You basically had homes, people who couldn't afford homes that had really poor credit. The banks, or should say investors, they were taking these packages of these mortgages to people who had really poor credit, and they were packaging them into these credit CDOs, collateralized debt obligations, and they were selling it to savvy investors, people who are already super rich, who are looking to get 5-6%, in interest. It's basically like buying an ETF, which is a collection of stocks, but in this term with mortgages. And basically they look at it and say, okay, great. This collection of mortgages is grade A, sounds good. So super safe, good to go. But then I'm going to go out and I'm going to take out an insurance policy on this, that if this collapses, which it isn't, and it shouldn't because it's grade A, that I'm going to get a lot of money in case this collapses. And the more risky the insurance is, excuse me, the more risky the mortgage back the CDO is, the more you have to pay for insurance premiums. So then AIG says, okay, great, we're going to go ahead and back that. And then AIG promises to foot the bill. What happened? Well, we found out in 2008 that all of those grade A CDOs, collateralized debt obligations, which is a fancy way of saying packaged mortgages, those grade A ones with the safest people who could invest, who could pay their mortgages. Well, we found out that they weren't grade A. We found out that they were actually grade F. There were people who had low wages, who had poor credit, and that the credit rating agencies were lying about the actual ratings. And then the whole stack of cards just fell down. And so, if we have anything even remotely close to that, this go around, you're going to see very, very quickly that a lot of banks are going to start to collapse. Will not be surprised if this is the first domino of many, because, like I said, these banks are very, very connected. They communicate a lot. They know each other. A lot of them have back end deals, and a lot of them make decisions based on what other people are making decisions because they all have a lot of the same information. So September 17th, economy collapses. 19th, Paulson Bernanke meet. That's when they come out. They submit the legislation. They did the $700 billion bailout with all the banks. That's how everything got broken up. And then here we go. They say in September 21, the end of greed is good era. I don't think so, because things have gotten even worse. And then we did the final bailout bill in September 23. And then the matter, I think, 3 or 4 months of the following year is when the stock market started to rebound again. If you ask me, right now, we are all the way back to where the first bank starts to fall. I think we would be somewhere here. So I want you guys to be very cognizant and very safe when it comes to your money. This is this is a recession, and this is something to where we're going to have to be very diligent with our money. Now, what should you do with your money? Well, I certainly would not be looking to invest as of right now. That doesn't mean that the stock markets are not going to rebound a month or two. But what I think is going to happen is that we're going to see a domino effect. Banks are going to continue to fall. We're going to see companies that are over leveraged, companies that maxed out on their Federal Reserve requirements of 10%. And eventually, you're going to probably see that there's a house of cards. Fed's going to come out. They're going to start doing bailouts again. And we really just have to see exactly right now who the biggest banks are that are exposed. One of the things that I had a major, major, major issue with in 2008, it still bothers me to this day, 15 years later, is that not only did the government bail out the banks, and I understand you have to do that to a degree because you can't allow the entire financial system to collapse, but they bailed out banks that I don't think that even needed to be bailed out. But that's not the worst part. What they did was is they hid who actually took, what you remember, the TARP money. So they gave all the major banks the TARP money, and they hid who actually needed the TARP money and who didn't need the TARP money, so that people wouldn't say, well, I'm not going to bank with this bank anymore because they are irresponsible. And I think that that's completely wrong and completely unethical. And if we find out that this go around that they're doing that, I think that there should be some type of, actions taken so that it doesn't occur. Because I think us as citizens and as investors and as people who bank at these banks, right? We have a responsibility to decide who we want to give our money to, and we should be allowed to know which banks are being responsible with our money. You shouldn't mask the bad banks with the good banks. If the good banks are doing the job, that should be known. If the bad banks are overexposed, they're over leveraged, they're being reckless with their investing and with their investments. We as investors and as people who bank at these banks need to know that. So I hope this go around that if the government does do bailouts, that they do not hide the names of the companies who needed the money, because we have a responsibility and a right to know, I believe, so that we can decide who we want to actually bank with. I want to leave you guys with this. Right now, it's a very turbulent time. Right now, it's very tumultuous. We're a little unsure and uncertain about what's going on, but I do think that we're going to get out of this in the next year and a half to 2 years. Obviously, no one knows how long this is going to go on. We don't know how bad it's going to get, but I do ask that you guys be diligent. Do not be afraid. Understand that during these types of times, recessions are very few and far between. We've only had two recessions in the past 23, 24 years. They are extremely, extremely rare. Now, if you're one of the fortunate people who are able to make it out on the other end of this, which I think most of us will, even if you're middle class, it's going to suck for a lot of people. But eventually, once we're able to make it out of it, we're able to get jobs back, and the economy starts to rebound towards the bottom of the market in the next year and a half or so, is going to be a phenomenal time to invest your money. If it's $100, $200, 1,000, 2, 3, 5, 10,000, wherever much you're going to put into the market, this is the best time to make money. So please be patient, be diligent. Don't be into a rush to go in there and put your money to the markets and anything right now. Let's wait. Let's see how this pans out. I want you guys to be safe. I want you to be responsible. And please make sure, above all else, make sure you like the video. Make sure you subscribe to the channel. If you guys don't know, we are a financial education channel. We follow and inform you guys to give you all the information that you need to make financial educated decisions for not only investing, but your day to day spending and saving, because we want everyone on this channel who follows us and likes the channel and our videos, of course, to achieve financial freedom. That's what this is all about. So hopefully you guys liked it. Make sure you thumbs it up. Thanks for watching. Talk to you later.